Hey guys, Barry Page here with Legacy Money. I've got a great educational video for you today. I'm going to talk to you about how you can become your own banker using whole life insurance. So why are we using whole life insurance for infinite banking? Well, you can use a number of assets. We happen to like whole life insurance. Nelson Nash chose it because it is a stable asset. It reduces risk. It provides a facility for savings over time. And it provides multiple uses for our money. It's a safe place to store our capital, to warehouse our wealth, and use it to buy other assets, cash flowing assets. It can provide income during retirement or supplement another plan. And ultimately, it provides estate benefits not available in other financial products. This is by no means an exhaustive discussion. If you've watched some of my other videos, some of it might sound a little redundant. If you haven't watched some of my other videos, then I recommend that you do for a more detailed explanation. But really what I want to do is break down the basics of how you build a policy and how you can get started becoming your own banker. So first things first, you're going to want to read Becoming Your Own Banker by R. Nelson Nash if you haven't already. If you have read the book, I recommend that you read it again and keep it handy so you can reread it and share it with your family and loved ones. Okay, let's talk about earned income. It all starts with our pay, how we get paid and how we utilize our income to save or plan for the future. We all have an earnings capacity over our lifetime. This money can be used to fund whole life insurance. Now, of course, you're going to have many expenses and things, other savings vehicles or investment vehicles in your lifetime. But specifically today, I just want to talk about funding a whole life policy. Money is the medium of exchange. Banking is the mechanism or how we pay to fund our purchases. The question is, who will be the banker? This is where things can get tricky. We've become accustomed to direct depositing our paychecks into the bank and paying our bills either online or through checks. You can do the same thing with a whole life insurance contract. You can have it paid for, the premiums, automatically. You can utilize online services to make loans, repay loans. So your earned income, and you can determine how much you want to fund a policy with. This can be a percentage or a number that you choose with your agent or whoever you might be working with. A whole life insurance policy can be funded a number of ways over a number of years. In funding a policy, you could utilize a 10-pay policy. That means it's contractually paid up after 10 years or 10 premiums. There might be a 20-pay. In between, there could be a 15-pay. Just depends on the company or the carrier. 10 pays and 20 pays are very popular. There's a fixed premium that goes into those policies. The disadvantage of these policies is there might not be a lot of leeway for a paid up additions rider. It just depends on how the policy is structured. Then there's the L65. This policy has been popular for a number of years because it's contractually paid up at age 65. And this is an age that people typically think of at retirement time. So they have a policy, it's contractually paid up when they retire from earning income at their job or workplace. Then you may have a whole life 100 or a whole life 120. That means the policies are contractually payable for life. If you live to be past 100, the policy would endow, be paid up at age 100. And then age 120, if you looked at mortality tables today, people are expected to live into the next century going forward. Capitalization is key when funding a policy for infinite banking. You'll want to capitalize over time. You can't do it all in 1 year. You'll do this over a lifetime. And again, this could be a system of policies, so it really just depends on your income and how you want to fund your system. At a minimum, it will take you 5 years to capitalize a policy. Most of the examples in Nelson's book, Becoming Your Own Banker, show 5 years. However, things have changed a lot since that book was written, and the typical policy today will take about 10 years to fully capitalize. You can fund a policy, capitalize a policy, again, all the way out here until your death. This is completely up to you. With a whole life insurance contract, there is a base premium. This is a number that the actuaries at the insurance company have determined to buy a certain amount of death benefit. With infinite banking, we typically tend to look at things differently. So we're not so concerned about the death benefit. However, it is important. We are talking about life insurance here. We're buying it for a reason. So you have your base premium. And then, if you like, there's something called paid up additional insurance, a PUA rider. You can put riders on these policies. You can even have a term rider, although some people like to have term insurance separately. The point is, over time, you're probably going to have multiple policies if you become your own banker. Nelson said this is to be a system of policies. So, you might own multiple policies. For instance, I own a 10-pay policy, I own a 20-pay, actually I own a few 20-pay policies because I have them on my children. I have a paid up at 65 policy. So everyone's situation is different depending on where you start in life. This can be determined based on how you want to fund it and how long you want to pay the premiums or have the ability to pay premiums. So if we look at this as time, you see this black line here and you see a green line. So some people kind of refer to the PUA as the cash value and the base as the death benefit, but that's not really true. In relative terms, they are going to come together at some point when the policy either endows or later on down the road. But in the beginning, if you want more access to capital, then you can use a PUA, paid up additional insurance rider. Now every company has its own names for PUA, and your policy, if it's a dividend paying whole life insurance contract from a mutual insurer, will pay dividends. And these dividends are typically used, they're reinvested, for lack of a better term, into the policy to buy paid up additional insurance. This paid up additional insurance is basically a separate policy. However, you can also buy more paid up additional insurance with a rider. And it's just as the name implies, it's paid up additional insurance. What does this mean? That means that it's paid up. Once it's paid up, no premiums are due, and it will continue to grow every year. So for instance, on a base contract, the PUAs inside the policy will earn dividends as well. So over time, that's why the policy is growing. And you can accelerate this growth in the early years by purchasing the PUA rider. Now again, when you add a PUA rider, this is going to cause the policy to accelerate, okay? And because of some laws that were created, we don't have to get into too much detail. Just understand you can't just buy all PUA or you can't put all of your money towards this because the policy will create something called a MEC. Your agent or advisor will help you with this. Now in some cases, if you want to add more to the PUA rider and have it not create a MEC, a modified endowment contract, which is an IRS rule, then you can add what's called a term rider to the policy. This will raise the death benefit and allow you to put more money in the paid up additions rider. In most cases, I like to have the term policy separate and just maximize the amount that can go into the PUA rider based on the policy, your age, and the number of years you want to contribute. The good thing about having a separate term policy is you can always convert it depending on the schedule set up when the policy was purchased. So again, this will all be based on the type of policy, your age at the time of purchase, and the amount that you want to contribute to the policy. Once a policy is in force, you will accumulate savings in the policy, similar to the same way that you might accumulate savings in a normal checking account or accumulate in an investment when you contribute on a regular basis. So you would be contributing via premiums to the policy. As you accumulate, the policy will grow over time. And once the policy is capitalized, which is very important, you will be able to use the policy for financing, for banking. The first rule of infinite banking is to think long term. So as you see here, if you have a 10-pay policy, this would probably come later in life, but if you had one early in life because you wanted to have the premiums contractually paid off, then maybe you had some term insurance and you wanted to convert that to another whole life policy later on in life. It might be convertible without evidence of insurability. So this means 5 years down the road, if you wanted some more whole life, you wanted another banking policy, you could convert that term to whole life at that point. If you want more information on this, be sure to check out my video on term life and what is the best policy to own. So sticking with traditional financial planning, at some point in life, maybe age 65, we will distribute the money that we've accumulated into our assets. We have to spend that money. And again, how we spend it will make all of the difference. So looking at this again, we're going to fund a policy and accumulate over time. We're going to use the policy for financing. In other words, we could take out a loan and borrow money from the insurance company using our policy as collateral. We can finance or borrow as much money that is available in the cash value of the policy. This will all be determined by you and how you fund your policy. In our working years, as we're accumulating money, as we're earning income, we definitely need to repay these loans. Now, what would we use the loans for? Well, if you have a major capital purchase and you cannot pay cash, you're going to have to finance. You're going to have to borrow money. And one of the questions I always get from people is, well, how am I going to repay the loan? Well, the same way that you would repay the bank or the financial institution that you borrowed the money from. In this case, you borrowed it against your policy. You're the banker, so you set the terms. There will be no hard payments other than the interest is due annually on the policy anniversary. So you can determine the payment schedule. You can determine how often, how much that you repay. But again, we recommend that you repay your loans with interest during your working years. Now later in life, again, we want to spend or distribute that money. It's not as important that we repay the loans at this point, but it may be important for the next generation. It's just up to you or possibly them should you share this with them. So as you see, if we're here and we want truly passive income, we can use our policy to distribute income when we get to that point in life. Now, many other assets you can use to distribute income, but you may have to pay taxes, you may have other costs involved, and you could run out of money. The truly great thing about life insurance is that you can access this capital completely tax-free. You just have to follow a few guidelines. You could even take dividends at that point in life and not have to worry about loans. If the policy is contractually paid up, you may at some point want to switch to loans once the policy, you have met your cost basis in the policy. So there's lots of options, lots of ways to go about it. If you choose, you can distribute all of that money in your lifetime back to you. If it's not important to you to leave a death benefit to the next generation or a legacy for your family and heirs, it's really up to you. Okay, a quick recap. We can take some of our earned income that we choose, a percentage, and determine how we want to fund a whole life insurance contract so we can become our own banker. When we become our own banker, we take control of the banking function in our life. So, as we fund this whole life insurance contract, it can be made up of base premium only, or it can have riders, such as a PUA rider. A paid-up additions rider allows you to accelerate the capital into the policy early. You can choose how you want to fund the policy over time. 10 pays, 20 pays, paid up at 65, and whole life 100 contracts are the most popular policies. You may also want to own a term policy or a term rider that you can convert later in life to another policy. This is typically a system of policies to become your own banker. And when you have a term rider or a separate term policy, you can convert that without evidence of insurability later in life. You'll want to speak to your agent about that. Every company is a little different, but this will be based on your health and net worth and financials at the time you apply. You can capitalize your policy over time. You'll be accumulating cash value in the policy. Once the policy is fully capitalized, or it can be sooner, we recommend a minimum of 5 years. However, you can utilize a policy much sooner than that. There will be more risk involved when you do that. So, you capitalize the policy as you like, and once the policy is capitalized, you can finance your major purchases. Now, we again recommend emergencies and opportunities, but anytime you have to spend capital, a major capital purchase that you can't afford to pay cash for, then you could utilize your policy via the loan provisions in the policy. You can then finance and repay the loans, be an honest banker, to put the money back into the policy where it can continue to grow. Now, your policy, the good thing about this, when you finance, you're only taking a lien against the policy. You're not borrowing from the policy, you're borrowing from the life insurance company. So the policy is used as collateral, okay? That's why it's important to repay the loans during your working years when you're earning an income. Now, later in life, we'll get to a point where we may want to retire or step back from working, or we want passive income. Most assets do not really distribute passive income. You're working in some capacity, but life insurance can truly be passive income. You can use dividends, or you can take loans at that time to fund your retirement, supplement your retirement, or basically in your later years in life if you need additional income or cash flow. Ultimately, we're going to leave the benefit, the death benefit of a policy to the next generation, or some type of legacy that we choose. We can choose a legacy of stewardship where we teach our family or others about infinite banking, so they never have to depend on traditional banks for lending either. When you become your own banker, you take responsibility for your finances. You control the banking function. You commit to a long-term plan and you optimize it over time. It can become more efficient and more effective as time goes on. IBC can help you reach your financial goals and remain in control of your money. So take action on your financial dreams and become your own banker. If I can help you, just let me know. If you like this video, I'd appreciate a thumbs up. Please leave your questions and comments below in the comments section. Thank you for joining me today. I'll see you in the next video.